You work for money, you save money, you worry about money, but almost no one ever explains what money actually is. We're told its value, we're told it's wealth, we're told it's security. But what if money isn't wealth at all? If it's something far more abstract and far more fragile? Every country on earth is in debt. Governments owe trillions. Inflation quietly eats purchasing power year after year. Crises repeat, markets crash, central banks intervene, and somehow the system survives. That pattern isn't random. It isn't accidental. It definitely isn't taught clearly in schools. To understand how money really works, we have to go back to where it began and follow the chain of cause and effect that reshaped the world. Money started as a solution to a problem. In early civilizations, people traded goods directly, wheat for cattle, labor for tools. But barter required coincidence. Both sides had to want what the other offered at the same time. That inefficiency pushed societies to adopt something widely accepted as a medium of exchange. Gold and silver rose to the top because they were scarce, durable, divisible, and difficult to counterfeit. At that stage, money represented something tangible. If you held gold, you held stored labor and stored value. It was wealth in physical form. But storing gold carried risks, so people deposited it with goldsmiths for safekeeping and received paper receipts in return. Those receipts were claims on gold, so over time, they became easier to exchange than the metal itself. That subtle shift changed everything. Money stopped being the asset and became a promise. The next transformation was even more profound. Goldsmiths noticed that not everyone reclaimed their gold at the same time. Most deposits just sat in vaults. So they began issuing more receipts than the gold they physically held, lending those extra receipts out at interest. This was the birth of fractional reserve banking. Money was no longer limited by physical metal. It could now be expanded through lending. When a bank issues a loan today, it doesn't hand out existing deposits. It creates new money electronically. That money didn't exist before the loan was made. But here's the part rarely emphasized. Banks create the principal, not the interest. If someone borrows $1,000 and must repay $1,100, the extra $100 doesn't exist unless someone else borrows it into existence. That means the system requires continuous expansion of debt. Without new loans, there isn't enough money in circulation to pay back old loans with interest. Growth isn't optional, it's structurally necessary. For a long time, paper money was still tied to gold through formal standards. Governments promised that currency could be redeemed for a fixed quantity of gold, limiting how much money could be created. But wars strained that promise. Governments needed more funds than their gold reserves allowed. They printed beyond their backing. Eventually, the tension became unsustainable. In 1971, under President Richard Nixon, the United States ended the dollar's convertibility to gold, effectively dissolving the Bretton Woods system. From that moment, the dollar, and soon most global currencies, became fiat money. Backed not by metal, but by government decree and public confidence, money was no longer anchored to a scarce commodity. It was anchored to trust. Once money became fiat, central banks gained immense flexibility. They could create reserves digitally, expand the money supply, and purchase government bonds. Governments could borrow more easily, running deficits without immediate physical constraints. Commercial banks could expand credit rapidly. Debt became the foundation of the system. Today, global debt exceeds global GDP. That sounds alarming, but within a debt-based monetary structure, it's logical. Money is largely created through borrowing. To reduce total debt dramatically would mean shrinking the money supply, triggering deflation and widespread defaults. So instead, the system expands. This expansion has consequences. When central banks inject liquidity, it doesn't flow evenly to every citizen. It enters through financial institutions, asset markets, and government channels. Those closest to new money access can deploy it before prices adjust. By the time it filters through wages and consumer spending, asset prices and living costs have already risen. This dynamic contributes to widening wealth inequality and persistent inflation. Inflation isn't just higher prices at the grocery store. It's the erosion of purchasing power over time. It rewards borrowers and penalizes savers. It transfers value quietly. The pattern repeats across decades. Credit expands, asset prices surge, optimism builds, leverage increases, and then something breaks. A market correction, a banking crisis, a liquidity freeze. Policymakers intervene to prevent systemic collapse. Interest rates fall, stimulus flows, balance sheets expand. The immediate crisis stabilizes, but the overall debt level rises. The cycle resets at a higher baseline. From the Great Depression to the 2008 financial crisis to pandemic-era stimulus, each intervention reinforces reliance on expansion. System survives, but becomes increasingly dependent on continued growth. Attempts to reform the structure rarely address its core design. Regulations may tighten after crises, but the reliance on credit remains. Governments finance spending through bond issuance. Corporations leverage debt for expansion and stock buybacks. Consumers depend on mortgages, auto loans, and student loans. If borrowing slows sharply, economic activity contracts, defaults rise, unemployment increases. That's why central banks monitor interest rates so carefully. Rates that are too high strain borrowers. Rates that are too low encourage speculation. Policymakers constantly balance between overheating and stagnation. Yet the underlying requirement persists. Debt must grow or the system stalls. Today, money is increasingly digital. Most transactions occur electronically. Central banks discuss digital currencies. Financial data moves instantly across borders. This enhances efficiency but also centralizes control. Monetary policy can now operate at unprecedented speed and scale. Meanwhile, household debt, corporate leverage, and sovereign obligations remain historically elevated. Inflation cycles reappear. Asset bubbles inflate in housing, equities, and new technologies. The pattern feels familiar because it is familiar. The mechanism hasn't changed, only its scale has. So what does this mean? First, money is not wealth itself. It is a claim on wealth. Real wealth consists of productive capacity, natural resources, innovation, and human effort. When money supply expands faster than real output, purchasing power adjusts. Second, debt is not a side effect of the modern economy. It is its engine. Without expanding credit, money supply contracts. That's why recessions trigger stimulus. System stability depends on continued borrowing. Third, inflation is not purely accidental. While policies and shocks influence it, a debt-based fiat system structurally leans toward gradual currency dilution over long periods. None of this implies inevitable collapse tomorrow. The system persists because confidence persists. Fiat currency functions because people accept it in exchange. As long as trust remains, transactions continue, wages are paid, and debts are rolled forward. But history shows that monetary systems ultimately depend on credibility. When confidence weakens significantly, adjustments occur, sometimes through inflation, sometimes restructuring, sometimes dramatic reform. The deeper question isn't whether money works. Clearly it does. Transactions happen, economies function, innovation continues. The deeper question is sustainability. Can perpetual debt expansion continue indefinitely in a world with physical and demographic limits? Can growth outpace obligations forever? Or will structural imbalances force future transformations? Understanding how money really works doesn't require conspiracy thinking. It requires tracing cause and effect. Gold became paper. Paper became credit. Credit became digital entries backed by policy and trust. Each step increased flexibility and complexity. Each step moved money further from tangible anchors and closer to abstract confidence. When you hear about inflation, rising national debt, or central bank rate decisions, you're witnessing the management of this structure in real time. Headlines become less mysterious once you understand the engine underneath them. Money is not a static store of value locked in a vault. It is a dynamic system built on lending, trust, and expansion. Recognizing that doesn't mean rejecting it. It means seeing it clearly. And once you see money as a system of interconnected promises rather than physical wealth, the world starts to look different. Economic cycles feel less random. Policy debates reveal deeper incentives. Financial crises look less like accidents and more like pressure releases within a tightly wound structure. The system runs quietly in the background of everyday life. Salaries deposit automatically, payments clear instantly, debt rolls forward. But beneath that smooth surface is a design few people are encouraged to examine closely. Understanding it is not about fear, it's about awareness. Because once you understand how money really works, You're no longer just reacting to economic events. You're interpreting them. And that shift changes everything.